there, and welcome to today's live Savant webinar. Today, we will be talking about financial basics for the non-money minded. But before we get into the agenda items, first, I just want to introduce the speakers of today's talk. My name's Cory Buehler. I am a financial advisor in Savant's downtown Chicago office location. I've been in the industry since 2014, and I got a degree in personal financial planning in 2014. Outside of work, I'm an avid volleyball player, a fan of the Kansas City Chiefs, and I like international travel. Rick, why don't you give yourself an introduction before we get into today's talk?
Yeah, glad to be here today with all of you. Like Cory said, my name is Rick Brown, and I've been a financial advisor with Savant in our Downers Grove, Illinois office for the last 5 years. I've been in the financial planning industry for the last 15 years. The first 10 were spent traveling around the country, actually partnering with financial advisors and their clients to help them with very specific retirement planning strategies. In 2018, I decided to, move across the desk and actually become one of the advisors. This is when I joined Savant and have been really happy with the move. I have 3 young children, so no longer traveling as much has been wonderful, and the holistic planning very rewarding as well. But enough about Cory and myself. Let's move on to the agenda for today. So we're excited to discuss some really important financial basics with you today. The first topic we're going to cover is the importance of an emergency fund. Then the bulk of the presentation will be spent covering the key areas of financial planning. And finally, we will touch on some of the common financial pitfalls that we see with clients and some of the ways best to avoid them.
Yeah, so the first topic we're going to talk about today is the importance of that emergency fund. And just to begin, what is an emergency fund? And it's also called a rainy day fund. And it's really the account that you have to cover any unfortunate events that come up. As we all know, things happen in life. And this account is there to cover things like a job loss, any major appliances breaking in your home, think washer, dryer, your car breaks down, or maybe you have to fix your roof. It's really just there for anything that comes up. And how you're supposed to fund this account, the goal is to set aside 3 to 6 months of non-discretionary income. And when I say non-discretionary, I mean things that you simply can't go without on a month-to-month basis. So think of things like your mortgage or your rent, groceries, utilities, things like that. Your discretionary expenses would be, going out to eat, going to concerts, to ball games, things that you can cut out if need be. So we recommend 3 to 6 months of those items. And, the first step you need to do is identify what that non-discretionary spending is on a month-to-month basis. And then you want to start setting funds aside. And it's really a comfort level, whether you want 3, 4, 5, or 6 months in that account. How should you invest those funds? These funds should be fully accessible, and you shouldn't be taking any risk with them. So not investing in the stock market nor the bond market. And 2022 is a prime example why. The stock market was down over 20%. The bond market was even down over double digits as well, above 10%. So you want these funds to be fully liquid, and we recommend that you invest them in just a high yield savings account. These accounts are earning anywhere from 3.5% to 4.5% these days. And they're liquid on a day-to-day basis, because at the end of the day, things happen. You're not always ready for them, but you want these funds to be available at any moment's notice. And then finally, I recommend my family, my friends, and clients have the account out of sight, out of mind. And what I mean by that is I bank at Bank of America. That's where my checking account is. I keep my emergency fund, I've had it at Ally or Marcus, it's an online high yield savings account, but it's at a separate institution. That way, whenever I log into my Bank of America account, I don't even see it. So I'm never tempted to use those funds for anything other than an emergency fund. So that's the importance of emergency fund. Now I'm going to pass it over to Rick, and he's going to talk about that comprehensive holistic planning we originally discussed.
Yeah, thanks, Corey. And like I said, the bulk of the presentation will be focused on the key areas of financial planning. So if we go to the next slide, there's this wheel that we use here. And this wheel is something we use as a guide in most of our client meetings. I really encourage our clients to look at this wheel as a financial health assessment, similar to an annual physical at the doctor. And what I mean by that is when you go in for a physical with your doctor, they want to check more than just one thing. This is the annual physical. So they're looking at your heart, your lungs, your ears, your eyes, etc. This is kind of the financial version of that full body checkup. When we meet with our clients, we want to look at more than just investments. We want to take a holistic look at all of the key elements of a sound financial plan, including things like insurance, estate planning, taxes, etc. So Corey and I plan to take some time covering each of these key elements now. And we're going to start with retirement planning. And the first topic that comes up when we get into retirement planning is your spending, and another way of looking at that is the budgeting. And, why is budgeting needed? Well, when we build out retirement plans, one of the main goals is to see how long you can make your money last in retirement. And I often find that the biggest driver of a plan's success or lack of success is the amount of spending that's taking place. Because of this, it's very important to set up a plan in order to have a good idea of what level of spending makes sense and what level is sustainable over the long term. So how do you best go about that? Well, there's plenty of great websites out there. You may have heard of You Need a Budget or Mint. There are options out there. Now you have to pay for those, and they tend to be, pretty granular and detailed. So if you don't want to go that deep into the weeds and put down every single one of your expenses, we at least recommend keeping a spreadsheet that shows your regular monthly expenses. And if you're not doing that, at the very least, you can take a look at your credit cards each month and just track how much money is going out on average on a monthly basis. And then, if spending and budgeting is one side of the equation when looking at a retirement plan, the other side of it is obviously how much money do you have? How are you saving to get there, right? And obviously you're going to need to save money in order to be able to spend on those budget items. So for clients who are not yet in retirement, we try to help them understand just how much they need to save in order to, be able to retire when they want to, but also in order to be able to spend what they want to in retirement. You can save in a variety of different investment vehicles, and it's really important to understand the pros and cons of each. So we try to help our clients develop essentially a bucket strategy from a tax standpoint by investing in a variety of different vehicles, such as IRAs, which are tax deferred, Roth IRAs, which are tax-free, and then also brokerage accounts and trusts where taxation's a little different. It will only be to the extent that the investments have gains, and that taxation's at a favorable rate. And then, when you've kind of figured out how much you can spend and what you need to save to make it work, the next step is when can I retire? How much can I spend? This is kind of the result of the plan. This is the key area where Savant advisors help out our clients. We help them understand, when they can afford to stop working based on what their main spending goals are. And the way we do this is we use a software that actually runs 1,000 simulations of variable market returns just to see if the plan will be successful based on their current level of assets they have and the projected spending that they want to do. And then the real key too is we continue to meet regularly, ideally at least once a year, to update this information as life happens. So if you go to the next slide, Corey, to kind of sum up the retirement planning, first and foremost, we need to identify goals. That's part of the spending and the budgeting. We call them SMART goals. And what that stands for is specific, measurable, achievable, relevant, and time-bound. From there, you need to understand that all plans will eventually change as life happens. This is why we use that planning software to account for that variability. It's important to update the plan at least once a year as things change in your life. And then when you truly take the time to establish a budget and monitor it, you'll likely find some areas where you can trim the fat with your spending, which will allow you to remain more disciplined and on track. With all that being said, even a good financial plan can unfortunately be derailed if you don't have appropriate insurance. So now Cory is going to talk to you a little bit more about the insurance side of the equation.
Yeah, thanks, Rick. And today, we're really only going to focus on one type of insurance, and that's life insurance. Although we assist our clients with all different types of insurance, including health, disability, long-term care. Honestly, this presentation, we don't have time to talk about all those. So we're just going to touch on the high-level basics of life insurance, starting with the purpose. And the main purpose for life insurance, there are a few, but the main one is protection. Right. We want to protect ourselves and our families from an untimely death. And the flip side for a purpose of life insurance is building wealth. So the two types of life insurance, one is term, the other is permanent. And term insurance is in the most simplest form. You purchase a set amount of a death benefit, let's say $1 million for a set term, 20 years. After the 20 years ends, the life insurance goes away. And you're grateful that you didn't have to use it. The reason people buy life insurance is really to replace their income stream during their working years, right? So whether one spouse or both partners work in a relationship, you want to cover their income stream with life insurance so that you don't lose their earnings if they were to pass away early and before retirement. And a lot of people only carry life insurance through their working years because once you're in retirement, you no longer have that income to replace. The other side, I mentioned building wealth with life insurance. That's that permanent life insurance policy, which goes all the way up until you pass away. And there are a few different types. You have whole life, universal life, and variable life, but it's a little more complex with those policies because now you're mixing investments and life insurance. So a lot of the times you'll hear there's a cash value in those policies. We typically recommend most of our clients to stick with term insurance just because it's the simplest and most times it's the most affordable. But there are certain times where permanent life insurance does make sense. That third point, how much coverage do we recommend? I can't give you a straight answer there because everyone's situation is different. There are a few things to consider when determining how much life insurance you need. The first is, do you have any major debts that you need to cover? Think about a mortgage or a student loan for yourself or your kids. If you were to pass away and you no longer have the income to pay off that mortgage, you want to make sure that's covered, and life insurance is a great vehicle to do that. The other thing is, how many dependents do you have? Getting them through K through 12, getting them through college, those are things to think about. And then just really, what are your goals in life and helping you achieve those goals? You want to make sure you're properly insured. That's something that we do with all of our clients via simple life insurance analysis to make sure they have enough coverage now and throughout their working career. And then the final point, I am going to talk about one other type of insurance. It's called umbrella insurance, and this is really liability coverage, so protecting against lawsuits. And I think we all know that we live in a pretty litigious society these days. And Rick talked about that financial plan. One thing that can always break a financial plan is a lawsuit. So this umbrella insurance, how it acts is, if you think about, you have home and auto insurance, each of those policies covers liability protection. And I'm just going to say typically it's $350K to $500K. What the umbrella does is it goes over those two policies and gives you additional liability insurance. And just to throw a quick example, I'm a football guy. So if I get in a car accident with Justin Fields, the quarterback of the Bears, and he can no longer play football, he could sue me for lost wages. Well, that's plenty of millions of dollars. So my umbrella insurance policy would kick in depending on how much coverage I have. Now, the policies typically come in increments of $1 million. And they're very affordable simply because these things don't come up all that often. And what we recommend is your retirement accounts. So Rick mentioned IRAs, 401ks, those are covered from lawsuits. It's those other assets we're worried about. Think about your home, your cars, jewelry, all those non-retirement accounts. We recommend you cover those assets with umbrella insurance. So if all those assets equal $2 million, we recommend getting $2 million of umbrella insurance coverage. So that's a wrap on insurance. I'm going to kick it over to Rick to talk a little bit about debt.
Yeah, and what I have found in conversations with friends, family, and clients is a lot of people just assume that debt is a bad thing, and that there are certainly good and bad debts. But let's start with the good. If done the right way, it does allow for you to build your credit score, which is a positive. And I think, over the last 10, 15 years, what we saw, even more importantly, it allows you to use your funds elsewhere. What I mean by that is, the low interest rate environment that we went through over the past decade plus allowed for individuals to cheaply borrow funds, which allowed them to keep their investments, and the investments were outpacing the interest rate being charged on the debt. For example, if you could borrow money, like refinance your mortgage at 3 to 4%, and keep your investments working for you, earning say 6 to 8%, you would have come out ahead in that scenario. So you really need to monitor what the interest rate environment is, and a lot of times there's a real dollars and cents argument to having an appropriate amount of debt. Now, unfortunately, interest rates are quite a bit higher, so that decision has become a little bit more difficult. One thing we always, I shouldn't say always, but often suggest is consider establishing what's called a HELOC, a home equity line of credit. This allows you to borrow for short-term needs off of the equity that you already have in your home. And what we recommend is just getting it set up and having it in place. You may never actually use it, but you only have to pay interest if and when you borrow off of it. So it makes sense to have it in place in case something comes up. You need a new roof or whatever that may be. This is another part of the emergency fund conversation that Cory had earlier. Now there is bad debt. What we want to make sure all of you avoid is piling up high balances of debt on credit cards. That can take you a long time to pay off, and credit card debt tends to be double-digit interest rates plus. One other debt that I'm not going to really spend time talking about, but we'll transition into the next section, is student loans. And Cory's going to speak about education planning so that we can learn about ways to potentially avoid the need for large student loans in the future.
Yeah, and before I get into education planning, one thing I meant to include in the beginning is if you submit questions through the chat box, Rick and I will address those at the end of the presentation. I've seen a couple come through, so just want to let you know we will address those and keep sending them in as they come to mind. So with education planning, the most common college savings account is the 529 plan. So what is a 529 plan? It's basically a Roth IRA. So you get tax-free growth for college saving, and it covers qualified expenses. Now, what is a qualified expense? Think of things like tuition, room and board, books and supplies. And it even goes beyond college. In certain states, you can spend it for K through 12 expenses as well. And to talk about the tax benefits of this account, the major tax benefit is that tax-free growth. So although you can spend the funds for K through 12 costs, again, we recommend letting those funds grow simply to experience that tax-free growth. Another tax benefit, and this depends on what state you live in, but you get a deduction for the contributions you make. So in the state of Illinois, on the first $20,000 of contributions you make to a 529 plan, you get a state tax deduction, which for $20,000 in Illinois, it equates to $1,000 off your taxes. And new legislation came out last year, which is actually makes it a bit more beneficial to save in these accounts. And in the past, there was always a worry of overfunding the accounts. And you basically had two options if you had money left over in a 529 plan. So let's say you saved in this account and you had some left over. Either your child went to a cheaper school than originally anticipated, or they didn't go to college at all. What could you do with the funds? And the first option was you could pass it to a beneficiary, and that could be yourself, your spouse, siblings of the original beneficiary, aunts, uncles, nieces, nephews, even cousins. That was your first choice. Alternatively, you could take money out of this account for non-qualified expenses, but you would be taxed on the gains and you would also get hit with a 10% penalty. So for investors and advisors, we are a bit hesitant on overfunding these accounts. It was a bit of a game of put enough in, but not too much. But new legislation passed last year, which now allows you to roll over up to $35,000 into a Roth IRA for that beneficiary. So think if it's your child that you're saving for, you have funds left over. Now you can roll over part of that 529 plan into a Roth IRA and really kickstart your kids' retirement savings, which is a great benefit that we see in our eyes. That's about it for 529 plan. But speaking of legislation, at Savant, we really try to stay on top of all the changes in the tax law. So Rick's going to talk a little bit about income tax planning and how we handle that at Savant.
Yeah, and I'll preface this by saying we could host an entire webinar just on tax planning, and from time to time we have. So, we've got a lot of topics today. My objective here is to just kind of keep this to the high level bullet points. Ultimately, income tax planning is all about legally minimizing the taxes that you pay throughout your lifetime. There are lots of different strategies you can use depending on your situation. And for example, one thing that you hear people say often is, when you're younger, you should be contributing to a Roth because you're, most likely in a lower tax bracket. And then maybe as you get older and move into a higher tax bracket, you should switch your contributions to traditional or pre-tax. And, in theory, that makes a lot of sense. But as we explore these things, we must understand that we cannot predict future tax brackets. We can't predict people's future income levels all the time. And this is really just one example of why tax planning is an ongoing exercise to continue throughout your life. Combining annual tax planning with that financial plan that I talked about earlier really can help you make tax smart decisions on a year-by-year basis based on your tax situation, based on current tax laws. As for strategies to reduce your taxes, while you're working, there's a few things you can do to reduce your tax liability. You can make contributions to your 401k or 403b plans at work. You can contribute to traditional IRAs up to the maximum annual limit. You can contribute to health savings accounts and 529 plans. And then, of course, when you file, you can get deductions for things like mortgage interest that you paid, charitable donations you made, and state and local taxes paid. But then when you're done working and you retire, some of these strategies either change or new strategies show up. And now you might be looking at income acceleration strategies, such as a Roth conversion. In retirement, we're starting to pay attention to, when is your Social Security going to begin? When are you required to start taking distributions from your IRAs? What are the projected tax brackets for the remainder of your life looking like? Thus, the point is, whether you are working or retired, tax planning is an ongoing process that we should be reviewing constantly. We review it annually at a minimum with our clients. Another way that we help to reduce taxes is directly through our investment philosophy. We really focus hard on trying to reduce capital gains by fund selection with the funds that we invest in. We try to execute tax loss harvesting when possible, and certainly the location of where we hold stocks and bonds, which I'll get into in a future slide, has a big impact on taxes as well. Since I touched on investment philosophy, moving forward, I'm going to have Cory talk a little bit more about Savant's investment philosophy.
Yeah, and we're just going to go over the philosophy that we utilize at Savant at a pretty high level here. So the first couple points, it's all about asset allocation. And asset allocation is basically how you're adjusting your resources, how you're implementing them between stocks, bonds, and alternative investments. And we see that that's really what drives returns and drives how much risk you want to take. So, Rick alluded to that financial plan. With our clients, we're looking to identify how much risk they need to take based on that financial plan. along with how much risk they are comfortable taking via a risk tolerance questionnaire. Because at the end of the day, we want to make sure you're comfortable with the amount of risk you're taking, and we want to put that in the plan to say, hey, is this amount of risk going to help you achieve your financial goals? Points 2 and 3 there, markets are efficient and they are not predictable. There are plenty of people out there that like to predict where the market's going to go, where certain companies are going to do well or not going to do well. We don't believe in any of that. We believe, the stock market's a very efficient machine. As new information comes out, it already processes that into the price of the securities. So it's not worth your time and effort to try to beat the stock market. It's more about using that asset allocation to grab the returns that the market is going to give you. So with that being said, we're not stock pickers. We don't invest in individual securities. We're investing in mutual funds and exchange traded funds, or ETFs. And what those funds do is give you instant diversification, because an ETF or a mutual fund is investing in hundreds, if not thousands, of individual securities, so that you're spreading the risk around in your portfolio. So you're investing in the US and the international markets, in large and in small companies, in value and in growth. And it's really a way to spread that risk around and smooth out the returns of your portfolio. And then picking the best managers is hard too. Certain managers outperform one year and then they don't the other. It's just not worth chasing those returns. Finally, Rick alluded to this already. Costs and taxes matter. And with our investment strategy, it's all about reducing costs and reducing taxes. And that's something that we constantly look at throughout the year, is we're not going to realize capital gains unless we absolutely have to. And the mutual funds and ETFs that we're selecting focus on low cost. So Rick, why don't you talk a little bit about asset location?
Yeah, so you just learned a little bit more about asset allocation, which obviously refers to your mix of stocks, bonds, and alternative investments. And that's really more of a risk reward discussion. What sort of risk are you willing to take to earn a certain amount of return? What most people don't understand as well is the concept of asset location, which refers to, which type of account are we going to put those stocks and bonds in? And you can see on the slide here that the different investment vehicles all have different tax consequences. As we've covered a little earlier, IRAs are taxed differently than Roth IRAs, are taxed differently than, trust and brokerage accounts. So if you have money in multiple types of accounts, let's say you're the type of person who has a brokerage account, an IRA, and a Roth IRA, you want to make sure you're investing your funds in the most tax efficient way. And what I mean by that is, if you have a 70% stock and 30% bond portfolio, it likely won't make sense to have an exact 70-30 mix in each of the 3 different accounts. So, for example, we want to keep more of the bonds inside of the IRA. This is because bonds pay dividends that would be taxed as ordinary income if they were held inside of the trust or the brokerage account. By holding them in the IRA, we can defer all the taxes on those dividends that are being paid. On the flip side of that discussion, we want to keep the most aggressive, high growth potential assets. So call that, small stocks or international small stocks. We want to put those in the Roth because all future growth in a Roth is tax-free, and we want to maximize the growth inside of that account because none of that growth will ever be taxed where it is taxed in a trust or in an IRA. So there's very specific strategic reasons as to where to hold different investments inside of these different account structures, and executing this asset location strategy appropriately could and theoretically should lead to a little bit of a better return, and ideally a larger nest egg for you and or your heirs. So let's move on to the estate planning portion of the presentation.
Yeah, and in the estate planning section, really what we're going to focus on are what are the pertinent documents everyone should have in place. And, there's a myth out there that only the wealthy need estate plan documents, and that's simply not true. Really, everyone needs to have certain estate plan documents in place. And to start, it's the POAs, which is power of attorney. And there's a power of attorney for healthcare and property. And basically, what these documents do is assign the authority to an individual called your agent to make decisions if you were ever incapacitated. So, put it into a real life example. Let's say something happens, you get in a car accident and you go into a coma. Who is going to make those healthcare decisions for you? Who is going to make the financial decisions for you? Who's going to pay your bills? Things like that. Now, there is a process via law that eventually will go into place. But if you have these documents in place, it's going to make the process a lot more efficient and timely for you and your spouse and your partner and your heirs. So that's just something to keep in mind. We recommend everyone has those powers of attorney in place for both property and healthcare. Next, you have a will and a trust document. The will basically dictates where your assets go once you pass away. So if you have family heirlooms or any art or any specific items you want to go to individuals, you would dictate that in a will. The trust, very similar to a will, but a trust adds a couple more benefits for you and your family. One is a trust helps protection from creditors. It also gives you a lot more flexibility with the distribution provisions with some of your assets. So again, put it into example. Let's say you pass away and you have minor children, ages 10 and 12. And at the age of 18, they're going to inherit all that money that you left behind. So what a trust can do is say, well, I don't want my 10 and 12-year-old now, when they turn 18, I don't want them to get $500,000 of assets. Well, a trust, you can set up provisions where they get a third at, let's say, 25, 30, and 35 when they're a little bit more mature and responsible with those funds. Then you have the living will and the advanced medical directive. Those are one and the same. This is basically end of life procedures. So if you're on life support, do you want to stay on life support or would you rather have them pull the plug? Again, this is a decision that you should make and you shouldn't have others making for you. So having this in place is a good idea, as well as for both the power of attorney for healthcare and that living will. Have copies with your primary physicians so that, again, it expedites the process if anything were to happen. The goal of all these documents and to have an estate plan in place, one is to avoid probate. And probate is basically the court process when you pass away. So even if you have a will in place, that will gets read in probate court, and that's how the assets are dispersed. People like to avoid probate for a couple of reasons. One, it's timely. It can take months to settle your estate. It's expensive because you have to deal with lawyers, and it's open to the public and creditors. So even just having a will in place doesn't avoid probate. When you have a trust in place, the assets will pass along to your heirs via the trust. Those avoid probate. I haven't brought up, retirement accounts, so IRAs and 401ks. Anything like that that has a beneficiary designation automatically passes to your heirs and avoids probate. So something to keep in mind. If you're looking to avoid probate, having a trust in place will accomplish that goal. And just some of the other items on the list, again, the trust has creditor protection, and it's all about minimizing or avoiding estate taxes. And at the federal level, each person has just under $13 million of estate exemption, meaning if you pass away, if you have under $13 million, you're not going to pay estate tax. At Illinois, it's the $4 million level. So if you have under $4 million and you pass away in Illinois, again, no estate tax. But the goal of estate planning, again, is to avoid or minimize the taxes you and your heirs have to pay. Another way you can do that is actually you can gift up to $17,000 per person on an annual basis, and that indexes to inflation each year. But for 2023, it's $17,000. So if you're looking to get rid of assets in life, you and your partner can each give away $17,000 a year. Another strategy to reduce your estate would be charitable planning, and I'm going to go ahead and pass it to Rick so we can talk a little bit about that.
Thanks, Cory. Charitable gifting is one of the few itemized deductions that still remain available when filing your taxes. So I just kind of want to talk about some of the ways to do this. And I always preface this by saying to be clear, at the end of the day, if you're giving money away, you're not going to be in a financially better decision or in a better position, right? It may save you a few dollars on taxes, but we also understand people are compelled to give and want to give. And what we want to focus on is, this line on the bottom of the slide here, that if you're planning to give, please work with your advisor to make sure that you're actually gifting in the most tax efficient manner. So what are those ways to give? First of all, a lot of people just cut a check to their charity of choice. And what you're going to see on this slide is there are plenty of other ways to do it. Unfortunately, a lot of times, even though people cut checks, they don't give enough to get themselves over the standard deduction when they file taxes. So they're not really getting a tax benefit for that gift. It's still a great thing to do. It's still wonderful for the charity, but there's no tax efficiency to it. So, another option is gifting appreciated assets. If you happen to have appreciated stock or other assets held inside of a taxable account, you can gift those assets to the charity. And the benefit here is avoiding capital gains taxes. So for example, had you bought a stock for $1 a share and then later sold it for $10 a share, you'd have to pay taxes on the $9 worth of gains. However, if you took that same stock and just gifted it to the charity, you'd be avoiding all of the capital gains taxes that you would have incurred had you sold the stock. A third option is called a donor advised fund. And a donor advised fund is probably a little more complex than the amount of time I have to talk about it here, but it allows you to front load multiple years worth of your charitable giving into one single year. And this way you get the large deduction in the year that you loaded up the fund, but you can still spread the gifts out to charities over multiple years. This is a strategy that you should consider if you happen to be in a year where you get bumped into a higher tax bracket, maybe you got a large bonus that year, or if you're in the last year of your employment and you know that future years you're going to be in a lower bracket, you want to do it when you're in your highest tax bracket so that you can, get the large tax deduction in the year that you can benefit from it the most. And then the final strategy here is called the QCD. Once you reach the age of 70 and a half, you are allowed to gift money directly out of your IRA using what's called a qualified charitable distribution. And the reason this is beneficial is because any other time you take money out of the IRA, it's going to be taxed as ordinary income. Remember, IRAs are tax deferred until money is withdrawn. So when you take money out of your IRA and you gift it, it escapes being taxed as ordinary income because of the fact that it was donated. And really, once you're in your 70s, this is the most tax efficient way to start making charitable gifts. So on that note, we've covered kind of the key areas of financial planning that we wanted to hit on. Let's just take a look at some of the common pitfalls that we had mentioned. Unfortunately, we've all become too aware of the fact that there's many types of fraud out there. And in order to best protect yourself, we do suggest running your credit report annually. We also suggest freezing your credit to prevent criminals from opening new accounts in your name. And then I think the most common pitfall, which we'll spend a little more time on, is really comes down to behavioral finance. I'll give one example, and then Cory's going to talk about some other things we hear. But buy low, sell high is a very commonly used phrase in investing, and it's also one that most people find very difficult to do. For example, if there was a 50% off sale at Target, I think most people wouldn't hesitate to go shopping for some deals. Yet when the market's down 50%, it's a different attitude. People are panicking and they want to sell. They have often no interest in buying, even though everything's on sale. So the buy low, sell high, while it makes sense, it's hard to do. And one of the reasons you partner with advisors like Team Savant is to hopefully hold your hand and walk through some of those scenarios. But Cory's going to hit on this a little bit more here on the next slide.
Yeah, and I think Rick kind of hit the nail on the head there is, we talked about all this holistic planning we do for our clients, but one of the biggest benefits I see is we're just there by your side when things do go poorly. 2022, you even have COVID in 2020, the housing financial crash in 2008, 2009. We're really there to be the rock and to just hold your hand and make sure we're walking you through it, because those are the times when you need to be disciplined. You need to stick with your investment philosophy. And so some of the things we hear from clients in regards to behavioral finance, you'll see the phrases on the screen. Let's stay in cash. These are unprecedented times. I'm not confident in the market right now. A lot of the times we set up the plan and everything's going to plan, and then we have market recessions. Those are common. They do happen. And the biggest thing is just to stay put, stick with your plan. Don't let emotions come into play. That's where, when you let emotions come into play, that's when mistakes are made. So just trying to separate those emotions from the investment decisions. That's one of the biggest things that is our job when we're working with clients, because at the end of the day, we just need to get out of our own way. The stock market over time, it's made us money. We just need to let it make us money. And when stuff does go on sale, as Rick put, when the stock market goes down, keep putting money in if you can, and stick with what you currently have in there. So that's the end of our scheduled presentation. We're going to go ahead and kick to Q&A, and I did see a couple questions come through. So Rick, I'll propose the first one. If you have properties and you're in the position to rent or sell, how does one prepare to do so in a way profits can be beneficial?
Sure. And there's a few things in that question. I mean, that could probably be a much longer conversation depending on this person's specific situation, but I kind of see it as a tax question. If you're planning to rent your properties, you want to make sure you talk to your tax professional about all of the expenses that you should be tracking for deductions. If you are planning to sell, one of the key ways to benefit from profits is called a 1031 exchange, where you can actually take the profits and reinvest them into either another investment property, or there are some funds that you can go into. So it's probably more of a longer discussion to have with your advisor or your tax planner, but there are certainly strategies, whether renting or selling, to reduce the taxation on those profits.
Yeah, and Rick, you mentioned, the taxation on the profits. Can you tell us the limit that is excluded if you sell your primary home after living in it for at least 2 years?
Yeah, if you sell your primary home as a couple, you have up to $500,000, and as a single up to $250,000, which will not be taxed. So I assumed this question was more rental properties when I answered that, but again, it probably a very specific question to this person, and we'd be happy to discuss it in more details with you if you wanted to, bring that to us. And then Cory, I did see one other question just regarding, I think this is when you were covering the umbrella policy, this came up, our IRA accounts protected from being taken in the case of a lawsuit, similar to 401k accounts?
Yeah, and the answer to that is yes. So 401, any retirement account, whether it's a 401k, 403b, or IRAs, which are individual retirement accounts, whether they're pre-tax or Roth, are protected against lawsuits. And I believe IRAs are protected up to $1 million.
And then a last minute question just came in. If one is in a long-term domestic partner relationship but not married, does it make sense to do financial planning as a couple as opposed to individually? I don't know that there's like a specific silver bullet answer to that. I actually have a couple situations like that, and some of them do it individually, some of them do it as a couple. It's really kind of a preference thing as far as how much you actually share of your assets, how much you want to go to each other if one of you were to pass. If you want your plan to be as if you were married, then I would say, yeah, let's do the plan together. But we can certainly do it either way, and can also adjust it and make changes along the way. So we see it both ways, and there's really no specific right way to do it, I should say.
Yeah, I 100% agree with that. And I have a couple situations like that as well. And I think it's just all based on comfort, whatever you and your partner are comfortable with, and just have that talk. And if you guys want to do it together, by all means. And if you want to keep it separate, I think it's just a comfort level. But we've seen it both ways where couples want to do it together and separate, and it works both ways. If at any time you're looking for more information about Savant and what we do, I invite you to go to savantwealth.com to learn more. Thanks again.